All right, so we just finally finished objective 3.3, and we're moving into 3.4, which is construct the financial statements. And if you went through chapter 2, you might be going, what? We already did that. Income statement, statement of retained earnings. Balance sheet, yes, but what we're doing now is we're using adjusting journal entries, which under accrual accounting and financial accounting that you're really learning in this course, it's a different ball game once we introduce adjusting journal entries, adjusted trial balances, and then the closing entries, which we'll cover in the next objective, the closing entries. So just big picture, we look at the whole process now in terms of what's changed, and I'm trying to get rid of my pen here. Stall. What do I got? Okay, I got a pointer. That's nice. It's called the accounting cycle. So what we did first was record and then post, put in the ledger, normal journal entries during the year. Somebody paid cash for something, or we paid cash, or had some transaction with an outside party. Those are normal journal entries. We created the trial balance, which we did before in chapter 2. But now what we're going to do is record adjusting entries and post them, and then create the adjusted trial balance. And after we have the adjusted trial balance, the only thing that isn't trued up or ready for the balance sheet is retained earnings still. So we'll follow the same process that we did before. So we have the normal journal entries here, number 1. We get the trial balance, and then step 3 and step 4 here are what we're inserting. And then you go back to what you know, which is from the adjusted trial balance. Works just the same. You'll create the income statement, statement of retained earnings, and the balance sheet. You can create the cash flow statement. We're going to skip that for now. Closing journal entries, that's part of this whole thing, but we'll see those in the next objective. And we call it a cycle because the last step is start all over again. Okay, so learning to do adjustments and adjusting entries, adjusting journal entries, and this accounting cycle, you really have to get it down. The rest of the term depends on you understanding adjusting entries, understanding the adjusted trial balance, and how the financial statements are created for that. And then the accounts are closed and you start over again. Really vital for the rest of the semester. So we're going to just jump into a case here. And this is a lot. And I think I said that on the first slide. This is a lot to keep track of. I mean, even if you know what you're doing, there are just so many calculations to do that it's easy to get off track in one place. Okay? So here is an unadjusted trial balance, or just trial balance. Then we'll have some adjustments in the middle. And here's an adjusted trial balance. Now, the adjustments, you could do those in a journal entry, then post them. This format here with the 6 columns is just kind of a quicker way to get to the adjusted trial balance. And just an FYI, looking ahead to the final exam, one portion of your final exam, outside of the MyLab portion, the portion I'm going to give you, will be an accounting cycle problem. And we'll give you something like this, mostly filled out. You have to make 1 or 2 adjustments, and then you'll have to move into creating financial statements. All right, so this is going to come back at the end of the term. So let's look at this information, and we can think about the journal entries. And we'll probably then go back to an Excel spreadsheet to complete those. Complete those adjustments there and the adjusted trial balance. Okay, so we're going to have a service revenue adjustment, interest, insurance expense, supplies expense, depreciation expense, and interest expense. We have 5 adjustments. These below, the past transactions, are already recorded in the journal, posted to the ledger, and their amounts are included in the trial balance, not the adjusted trial balance, the unadjusted trial balance. But we need to get this information to adjust the accounts. A customer paid $12,000 on 10/1 for 1 year of service. So it's $12,000 per year. So it's 12,000 divided by 12 is service per month. October, November, December times 3 months. This adjustment is going to be for $3,000, and it's for a year of service, so it's going to affect service revenue and unearned service revenue. The corporation paid $4,000 on 10/1 of the current year, should say year there, for 1 year of insurance coverage. So October, November, December, they have 3 out of 12 months, and they paid $4,000 for the full year. So that looks like $1,000. Okay, so we're going to have a $3,000 adjustment, and this will be to reduce prepaid insurance expense and increase insurance expense. They have an ending supplies inventory of $2,000. Okay, let's go. That one we could do in the chart. So you have a $4,000 debit here to start. Somebody did inventory and say, hey, we have $2,000 ending. The only way to get there is with a $2,000 credit. So our supply expense is going to be $2,000. Now, what I'm going to tell you with these adjustment columns, you have to have debits equal credits. So supplies is reduced and expense is increased. Supplies expense is increased. And we also have to do this revenue one here too. Okay. So that would have been the supplies expense journal entry, debit supplies expense, and credit supplies. Okay. See the next one. The equipment was purchased on 1/1 of this year, so it's a full year. We don't have to make a partial year adjustment. It has a $10,000 residual value and a 10-year useful life. So they're telling us they have one piece of equipment. Here it is, property, plant, equipment, $60,000. So I'll take this one down here. Depreciation expense equals $60,000. Now they don't have any other equipment, so we know this is the only one they have. 10-year useful life, that should be $5,000. Okay. And the long-term note payable was issued on 1/1 of this year, and the interest rate is 10%. So it's a full year. We don't have to do a partial. So let me get a different colored pen here. Interest expense equals the principal amount, $20,000. Should be 2,000. It's a full year. Okay. So those are all the amounts. You know, I'll tell you what. We need to. I think maybe it's good for you to see those journal entries. So hold on a second here. Okay, so I'm back. I think you probably would benefit from seeing the full journal entry, so I put a little journal row in there. So we mentioned before, still the same problem, and so let's go back down and see where we're headed. So every single one of those journal entries will go right in this area here, in the adjustments. And there'll be a debit and a credit and a debit and offsetting credit for every single one of those journal entries because a journal entry has a debit and has offsetting credits in the same amount. Let's see if I can get Control Z. That's great. All right, and then what you're going to do is take your credit here in this column and net it against whatever's over here and come up with your new total. So this adjustments column, these are just changes in the balance. Here's the new adjusted trial balances over here. So really, these adjusting entries are just entries. And instead of going to all the trouble of posting them in the ledger, we're going to do the adjustment right here in this middle two columns. All right, but we still have to get the journal entries right no matter what. For 1 year of service, the customer paid. So what's happening is we're going to recognize service revenue. And when they paid, we put it in a liability account called unearned service revenue. It's kind of weird that it's a liability, but it is. It means we still owe somebody some work. And we calculated the amount. It's 3 months. 3 months times 1,000 per month because it's 12,000 for a year. That equals 3,000. 3,000. 3,000. Okay, so now what you do is unearned service revenue and service revenue. We have to go all the way down here. Unearned service revenue. Where are you? There you are. What did it say? 3,000. Oh, it's a credit, but we're debiting it. And you increase the revenue with a credit. Okay, see, every single journal entry will have a debit and a credit. So if there's a mistake in the balance, sometimes what happens is something like this. You do your revenue, and then you're like, oh, darn, I forgot to do the other account. And you find out later. Okay. So that's service revenue adjusting entry. Here's insurance expense. And we know insurance expense is a debit. So once again, I'm not looking at the amount here. We're going to reduce the asset prepaid insurance. They paid $4,000 in October, so the amount per month is 4,000 divided by 12. It's October, November, December. The number of months is 3. So this is 4,000 divided by 12 is the amount of expense per month. And 3 is the number of months that we used up this year. So that looks like $1,000. That worked out nicely. Okay, and let's go post that one. So this is going to take a while, but I'm walking you through it real slowly. So let's do the expense first, 1,000. And then we got to go up here to prepaid insurance and expenses is debit. Reduction in the prepaid insurance is a credit. So expenses are either incurring a liability or reducing an asset, using up an asset. Okay, supplies expense. So we know that in the supplies account, they had 4,000 at the beginning of the year. The inventory is 2,000. So it must be the case that they used up 2,000. That's the number. It's going to be 2,000. 2,000. Supplies expense, and we're reducing the asset called supplies. Okay, then we're talking about equipment, using up equipment. Let's put the accounts before we think of the number. If we're using up equipment, it's depreciation expense, debit, accumulated depreciation credit. All right, so they purchased it on 1/1 this year. It's going to be a full year with a $10,000 residual value. So this is brand new equipment. It's the only equipment they own. Our trustee, $60,000 case here. 60,000 minus 10,000 divided by 12, and it's out the full year, so we don't have to take a fraction of the year. So 50,000 divided by 12. Oh, what am I doing? $50,000 divided by 10. I was going to say I like round numbers for these problems. If it wasn't going to be a round number, I was going to change one. All right, so depreciation expense 5,000, accumulated depreciation 5,000, depreciation expense 5,000, accumulated depreciation 5,000, supply expense 2,000, credit supplies reducing the asset, supply asset 2,000. Finally, interest expense. I know this has been a long way, but I just kind of felt I might be losing you if I just rushed through those bullet points. Long-term note payables issued 1/1 this year. Interest rate is 10%. Let's see how much the long-term note is. Right here, it's 20,000. So it's the principal amount times the interest rate. We're recording interest expense. Interest expense, we owe it but haven't paid it. So it will be interest payable. And we go to interest expense. And then we go up to interest payable, and always try to do these in pairs. The most frequent error is you do one side of it, but not the other. Okay, so those are all of our adjustments. And this has been a pretty long video, so what I'm going to do is stop it here. And then, but we're not finished with this problem. What I'll do is start it in Excel so we can add it up properly.